Dollar in the endgame will be replaced by some other currency. Maybe the euro, maybe a BRICS currency, maybe the ruble, maybe the shekel, maybe the Iranian, whatever it is. No, none of those will replace the dollar because all of them are derivatives of the dollar. We are in a dollar-based credit system, which is on a gold-based money system. The only thing that remains is gold and silver. Once the dollar collapses, there will be no currencies in the immediate aftermath.
The markets, they know that there's a new Fed chair coming in May. So we know we're going to get more rate cuts. Now, on the other side, the market is concerned, are we slipping into a recession? The answer here very clearly from the ADP jobs number on Wednesday and today's non-farm payrolls, we are not, at least per the numbers. But the bottom line is the economy, at least per the numbers, is hanging in there, and we're likely to get more rate cuts when we get to May and further beyond this year with a new Fed chair picked by President Trump.
The global financial system is moving closer to an unavoidable inflection point. Despite headlines about alternative currencies, the reality is that the current structure remains a dollar-based credit system. That system is showing late-cycle stress as policymakers prepare for the next round of monetary easing. Rafi Farber, a longtime analyst of monetary history, and Gareth Soloway, a respected market technician, explain why no fiat currency can truly replace the US dollar once confidence breaks. They argue that the euro, BRICS currencies, or any regional alternatives are still derivatives of the same credit framework. When that framework fails, what remains is not another paper unit, but gold and silver as final settlement assets. Markets are already pricing in change, with expectations of a new Fed chair by May and further rate cuts ahead. While employment data suggests the economy is holding together for now, easier policy only accelerates currency debasement. That backdrop keeps precious metals firmly in focus as the endgame hedge. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
We went off the gold standard in 1971. No, we did not. The dollar is still a note for gold. The technical reason is that gold still exists on the Federal Reserve's balance sheet, and the dollar is still a liability unit of the Federal Reserve. By definition, that's what it is. Underneath all of the debt that exists on the Fed's balance sheet, which issues the dollar, there still is a pile of gold there, or gold certificates. The gold certificates, yes, they represent gold, but the gold itself, assuming that it's there, is still backing the dollar. The debt is on top of that. The reason that you can't go off the gold standard, that it is impossible, is because of the monetary regression principle, or Mises's monetary regression theorem, as the Austrian school economists call it. That means that prices have a certain meaning. They convey information. With that information, we engage in a division of labor. The division of labor makes everyone know what they're supposed to be doing that day so that we don't end up in a zombie apocalypse. The only way for prices to maintain any semblance of reality is for them to be linked to the past. The only reason that you know what you need to do today is because you know what you needed to do yesterday, and so on and so forth into the past. At some point in the past, a dollar was issued in representation of gold, representation of or storage of gold, which was the original money. The dollar continued from that chain, and that chain continues today. Every time there's a big bump in the chain, there's a big economic hyperinflation or depression, something like that. But at the end of a hyperinflation, you always go back to gold or silver. And at the end of a deflation, gold to dollars or gold to whatever currency it is gets revalued. For example, in 1933, it was from 21 to 35, and that was a huge bump in the road. But you can't go off the gold standard. It is impossible. What the dollar can do, if the dollar goes off the gold standard, you stop using dollars. Fiat enthusiasts, they like to tell me, well, gold isn't money because you can't use it in exchange for things directly. Well, I say, yes, that's true. Dollars are the required derivative of gold that you use in a store in exchange for things. But If you go to a store and you try to acquire things with dollars, if those dollars have no gold value, meaning there is no exchange rate between those dollars or that currency, whatever it is, and gold, then nobody will accept the dollars. When you trade dollars for something, you are trading the gold value of those dollars for that thing. If those dollars or that currency has no gold value, it is valueless and it cannot be used for anything. The gold window is still open. We have not gone off the gold standard. When we do, meaning there is no longer an exchange rate between any amount of gold and any amount of dollars, the dollar will cease to be a credit derivative and it will die and nobody will use it anymore. The goal of all stackers should be to end the gold standard once and for all so that nobody is able to use dollars anymore, so that everyone returns to money, so that the government can no longer inflate the dollar supply and thereby suck gold value from us, the citizenry, and make itself richer by the process of thieving from us. The gold standard has not ended. The goal is to end it and start over.
Gold was able to eke out a gain yesterday, inching up just a little bit today. Look at the beautiful wedge pattern. It's stuck in here. This gives us a very clear range, right? From here to here, from here to here. And these two lines will tighten over time, meaning that at some point in the future, probably within the next month or so, gold is either going to have to break out or break down. Which way it's going to go, I honestly don't know with gold, because I'm obviously a bull on gold longer term. Shorter term, it's attracted a lot of weak hands, speculators, and I never like having that in a trade. It means it's a little frothy in the near term and may have to kind of wash those players out. But nonetheless, either way, I still like it longer term.
The notion that the world went off the gold standard in 1971 is technically incorrect. The dollar remains a liability of the Federal Reserve, backed by gold certificates and a chain of value that traces back to the original issuance of gold-backed dollars. This continuity is critical because prices convey information necessary for the division of labor and economic coordination. When the chain of gold backing is disrupted, the economy experiences hyperinflation or severe deflation, but historically, it always reverts to gold or silver to restore balance. Today, the gold window remains open, and the dollar continues to function as a derivative of gold. The fundamental goal for long-term holders of precious metals is to end the gold standard officially, removing fiat inflationary power and returning to sound money. Gold remains technically strong, and its longer-term bullish case is intact. Let's get back to the interview.
Silver was demonetized in 1873. No, you cannot make a money a non-money. Silver's nature as a metal was not changed in 1873. It's the same metal it was back then. It will be the same metal long after we're gone. It will not change. So what happened in 1873? A law was passed that the government would no longer be exchanging its credit, or the banks would no longer be exchanging their credit notes for silver, only for gold. So that cut off a lot of the demand for silver, the monetary demand for silver, in favor of gold. And truth be told, gold money is more stable than silver money because gold is more liquid than silver, at least gold derivatives, honest gold derivatives. If they represent honestly gold, then they are more liquid than silver itself. But that doesn't mean silver is demonetized. It just means that its monetary demand is now masked by gold derivatives. But when those gold derivatives no longer work because they've been so inflated above the gold supply that nobody trusts that they represent any amount of gold at all, the monetary demand for silver will reassert itself suddenly, because if no gold derivative works, there is nothing else you can use to divide goods and services on a retail level but silver itself. And that appears to be what is happening now, and why silver goes parabolic every now and then as gold derivatives tend to die out. It almost died in 1979, 1980, but Volcker was able to jack interest rates up to keep the gold derivative alive. But this time, They won't be able to, and silver will keep going up and up until its dollar equivalent is undefined and we go back to silver coins out of necessity to maintain whatever remains of the division of labor before a zombie apocalypse ensues. Money used to be gold, but now it's debt. No, money is still gold. It's still on the balance sheet. The debt did not replace the gold dollar. It's just built on top of it. You have a huge mountain of debt. The mountain of debt does not float in the air. It rests on some foundation. That foundation is gold. The gold is still on the Fed's balance sheet. The dollar is still gold at 42.22 an ounce. Money is not debt. Credit is debt. Literally, credit is debt, because if I credit you $1, you are in debt to me $1 by definition. Credit and debt are the same thing from other sides, from other perspectives, from different perspectives. Same, different side of the same coin, as literal as you can make that. Money is not debt. Credit is debt. Credit did not replace money. It's built on top of it. We are not in a debt-based money system. We are in a debt-based credit system, and gold is still money. When credit no longer represents money, the credit will be worthless. The money will remain, and everyone will have to use whatever money they can find or whatever money they have, or be ejected from the division of labor until they can figure out how to earn it. The dollar in the end game will be replaced by some other currency. Maybe the euro, maybe a BRICS currency, maybe the ruble, maybe the shekel, maybe the Iranian, whatever it is. No, none of those will replace the dollar, because all of them are derivatives of the dollar. We are in a dollar-based credit system, which is on a gold-based money system. The dollar backs every other currency on the planet because in the central banks of other currencies is a reserve of dollars. It's as literal as you can make it. If the dollar collapses, all other currencies collapse with it because every other currency is based on the dollar. The only thing that remains is gold and silver. Once the dollar collapses, there will be no currencies in the immediate aftermath. You will build them up later based on a new credit system, which will again be based on gold and silver, hopefully this time more honestly, but that's going to take time. In the immediate aftermath, there will be no currency replacing the dollar. It will simply be gold and silver. That's it. Gold and silver are not investments. They are money. Money is what you invest in other things. Buying or acquiring or trading your credit, meaning your dollars or whatever currency you use, trading your credit for gold and silver is not investing. It's divesting. The system that everyone is stuck in is a debt/credit system. In order to get out of that system, to divest from it completely, you have to get out of the bottom layer of credit, which is dollars itself. If you own a currency, you are invested by virtue of owning that currency in the central bank issuer of that currency. If you own dollars, you invest in the Fed. If you own euros, you invest in the ECB. If you own shekels, you invest in the Bank of Israel. And most of these central banks, in turn, invest in the Fed because they have dollars in their balance sheet. That's why it's a dollar-based credit system. The only way to divest completely from central banks is to acquire money itself. And then what happens is, as the credit system falls apart and credit loses all purchasing power, all of the stuff that existed before the credit structure fell over still exists the day after. And so therefore, all of the purchasing power moves away from credit towards money, and those who own the most liquid commodities in the world will have the most liquidity and the most ability to acquire all of the capital systems that were being maintained by the credit system that is about to fall over and die. We're running out of time. The end game is coming. I don't know what silver will be tomorrow. I think we crossed 81 or 82 yesterday. It could be 85 to 100 any day now. Who knows where the interim top will be? No, I don't think we're quite in the end game yet. But once the next banking crisis hits, and we embark on the final printing round, which we started because QE did start, but we're not in full gear yet. Once we are in full gear on the final printing round, the end game will be directly afterward. I don't know how much time we have, but it's not very long.
Silver again continues to hammer, but hold on its major trend line. This trend line goes back to November. And again, look at how many times we've hammered on this line and held. Great example was yesterday, and even today we got down there and it bounced back up. So silver is holding up right now. So same thing applies to silver here. Which way is it going to go? We have a very defined high, which was our bearish reversal signal. All right. That means that overall the odds do favor a breakdown because this is the dominant candle right now. But again, will it do it? We'll see. It's a probability-based thing. If it breaks above here, obviously it's off to the races. If it breaks here, that's where you get your bigger correction, likely into the mid 60s or even 60 on silver. But again, we don't know which way it'll go for sure. What we do know is this is your dominant candle, and that will be dominant, which is bearish reversal, until we take out this high at around just below 84 per ounce.
The monetary history of silver shows that it can never truly be demonetized. Despite the 1873 law favoring gold over silver, the metal's intrinsic value remains unchanged, and its role as money persists. Today, the dollar continues to derive its value from gold, and the global credit system is built on that foundation. As credit weakens and fiat currencies face structural stress, gold and silver will reassert themselves as the only reliable forms of money. Physical accumulation, institutional repatriation, and removal of counterparty risk signal that the market is preparing for a systemic shift. Silver continues to hold critical trend lines, and its next move could see unprecedented gains as the dollar-based system falters. Timing is uncertain, but the trajectory toward money over credit is unmistakable. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.